In this presentation, we're going to record a sale on account, which basically means we're going to be creating an invoice. A sale on account or a sale on credit is often what you'll hear when you're in financial accounting. So if you're recording this with debits and credits in a financial accounting type of setup, then you might hear record sales on account or record sales on credit. In essence, the form supporting that being the invoice. Here we go with Xero. Here we are in our Get Great Guitars dashboard. We're going to open up the trial balance because we have seen this before, so we're going to be entering the trial balance so we can consider it on that kind of more easy type of financial statement with all the accounts on one financial statement or one report rather than the balance sheet and income statement. Going to right click on the tab up top and duplicate that tab. Then we'll adjust the dates. We're going to be in the month of February, so we're going to bring this out to the month of February, so February 29th, and update that report. We will be creating an invoice in order to sell in inventory. So what's going to be the accounts that will be affected? Just like the invoices we've created in the past, it's going to be accounts receivable is going to be going up for the full amount, including sales tax. The other side is going to be going to the income statement account of revenue, merchandise revenue, a sales type of account. The difference between those two is going to be going to the payable account, which is going to be the sales tax liability account. Then we also know that inventory should be going down for the inventory we're selling, and the cost of goods sold expense account on the income statement will be going up. Let's check it out. We're going to go back to the first tab. We're going to be going down to the plus button. Let's go over to the old plus button here, and we will be creating an invoice. The invoice is going to Music Stuff Store. Is going to be our customer. So let's type that on in here. Music Stuff Store. That's the one we want. And the date we're going to say is the 19th. So I'm going to bring this on up to the 19th. Then we need a due date, which I'm going to say is March 19th. And then we can go down to the item that we're going to be selling. The item will be, we're going to sell another ELP Epiphone Standard Pro guitar. And we're going to sell one of those at the 500, and there is sales tax. So there's the 500. What's going to be the effect of this invoice? It's going to be increasing the accounts receivable by the 547.5. It's going to be increasing the sales by the amount we get to keep, the 500. Difference between the two is going to be increasing the payable liability account, 4750. Also, the inventory will be going down by some amount that's not going to be on this invoice, but is driven by this invoice by known by the inventory item. I believe it's going to be $400. And then the cost of goods sold expense account will also be going up by that $400. So now we're going to create another one. So instead of hitting just approve, I'm going to select the old drop down, which is actually going to be a rise up kind of screen, hopefully. Actually, no, it's going to be a drop down, and I got to scroll down. So it's going to be, and we want to approve and add another. Approve and add another. Next invoice is going to be going to Smith. So I'm going to say Smith Guitars. So there we have Smith. We've done business with Smith before, and we're going to say this is also on the 19th, and then that means the due date. We're going to say it's February 19th. Then we're going to go on down to the item. This one's going to be an Epiphone semi-hollow body this time, so that's the one that Smith wants, an Epiphone semi-hollow body. Let's see if we can find that one here. I think this is the one, the ESH. So yeah, the Epiphone semi-hollow body, $400. That's the one we want. So we have the 400 here. What's going to happen with this one? Well, it's going to be increasing the accounts receivable by the 438, increasing sales on the income statement side by 400, difference sales tax liability account 38, also bringing down the inventory by some amount that's not on this invoice, and then the cost of goods sold will be going up by that same amount that's not on this invoice but is driven by the invoice known by the service item. Let's approve this one and see what happens. So we're going to approve it, make sure that nothing funny happens. I got an approval item up top. That looks good. Going to go back to the trial balance now. Let's go ahead and update the trial balance so we have the up-to-date information. Then we know that there's going to be an increase to the accounts receivable. So we're going to go on down to the accounts receivable, go into the accounts receivable. These two items, I think if I put the date in there correctly, was on the February 19th, was it? So we're going to go down to the bottom, and we're going to look for those two invoices. February 19th, there they are, the 547.50 and the 438. Those are for the total amount, including the sales tax. The other side is going to be on the income statement account, so it's going to be on below on the trial balance. The trial balance, as we recall, is in order: assets, then liabilities, then equity, then income, and expenses. So we're going to be down here in the merchandising income. We'll go on into the merchandising income. Then down at the bottom here, we have our two sales for the 500 and the 400 on the February 19th. The difference between the two is going to be for the sales tax, the difference between the accounts receivable and the amount recorded in the sales or revenue line being sales tax, that going to an accounts payable account. So that's going to be in the accounts payable. It goes assets, then liabilities. So it's going to be in the liabilities section in the sales tax payable. So it's in there. I won't open it up. We've done that before. Then we know that the inventory is going to be going down. So the inventory asset is going to be here. It shall be decreasing by some amount that wasn't on the actual invoice, but was driven by the invoice. The system knows what amount it should go down by, given the fact that we have the items on the invoice. So that means it went down by the 320 and the 400 for the two invoices, and the other side of that will of course be on the income side of things, the cost related to us using the inventory in order to help to generate revenue. That's an expense type of account, a special expense, that being cost of goods sold. So let's go on down to the cost of goods sold and take a look at that. And if we go down to the cost of goods sold, we have the 320 and the 400 in there as well. So that's going to be it for now. Let's go to the beach.